Right, welcome everybody to another Investonline webinar. I'm Nick Brummer and very honored to have John Biccard from 91 presenting for us on his value fund. I'm the director of Investonline. We're financial planners based here in Cape Town. We do investment advice and financial planning, operate with a team of 15. And we have these regular webinars, which I'm sure a lot of you have attended already. Today, we're talking just all investments, and we've got the top fund manager in the country, John Biccard from New York. John lives in New York. John, thanks a lot for joining us. We really appreciate it. Just a quick intro to John. John, I think you've been investing for a long time. I would think, not to age you too much, but probably at least 40 years, I would think, from buying your first shares as a student and then starting to work as an analyst at HSBC. It was Simpson McKee in those days. John and I used to work together. John was a retail analyst. Then after some years, I moved on to Deutsche Securities and John left and he went to Investec. And that's when he started managing the value fund, which obviously moved over to 91. So many, many years of investment experiences. And John, yeah, thanks a lot. I know that you've got some slides. We're going to go through that. And we're going to start off by just looking at your performance, which is absolutely fantastic. I mean, that's one thing about investing or running money is there's nowhere to hide. So John, if you can, we're going to share some slides and then start going through your performance and then your recipe for success.
Thank you, Nick, and afternoon to you and all your clients. And very excited to present on the Value Fund, which, as Nick's, we've been known each other for a long time, and I've been now running the fund for 25 years. So it's actually the 25th anniversary. So I'm going to start off with the performance of the fund, and this is the very long-term performance since the day I started running it. And the purpose of this slide is really twofold. The first one, it is a marketing slide to show you how well we've done and to show the track record. But more importantly, it's also a way of introducing how we do it. Because when you look at the long-term performance, I'll talk to how we've managed to achieve it. So just a description of what we're looking at here. The value fund is the black line at the top. The all-share index is the green line in the middle. And the average general equity fund is the red line at the bottom.
John, can I maybe just chip in there and just tell me if I'm right? But I was just having a look now through that period. There's this share called NASPAS, which has been part of the all-share index, and I did some rough calculations. And over the last 20 years, I think it's averaged about 24% return.
Yeah.
And just roughly, if you said there was an average of about 15% in the index, that probably would have given an extra 2% to that performance, which you were not part of because you as a value investor wouldn't have invested in a growth company like NASPAS.
Yeah. So that's true. So we managed to achieve that without, probably in the 25 years, there probably was, I think there was 6 months that we held NASPAS. It was right at the beginning and sometime in the early 2000s when the share was like a couple of rand and was worth the same as their head office in the foreshore. And that's when I would have bought it. But it went doubled and then I sold it and then it went up another 100 times, whatever. But the point is, value investing, you can do it without those big stocks, as you point out. So, which brings me really to the first point I'd make, which is it's not a great advert for active investing. So if you look at the gap between the average general equity fund, the red, and the all-share index, the green, you can see the first 15 years of this graph, the two tracked each other very well. They were basically getting index performance. But the last 10 years, the average fund has not kept pace with the market. In fact, has lagged considerably. So it's a very bad advert for active managers and a very good advert for businesses like Nick's, where he's going to try and select not the average fund. And it suggests that if you pick the average fund, you may as well pick the index, which is the truth. And to Nick's point about NASPAS, one of the reasons the two lines have diverted the last 10 years, a lot of it has to do with NASPAS, that people didn't have enough NASPAS, so they lagged. And the last few years, they didn't have enough gold and platinum. So, and it brings me really to how does the value fund achieve that black line over the 25 years? And the answer is not really that I'm much smarter than everyone else. It's not really that I work much harder. The main differential why the value fund does well is that I'm not worried about quarter by quarter performance. And that is a big thing in active management in South Africa and indeed across the world, is you have to report to your clients every 3 months. And if you don't have NASPAS this quarter and you're lagging, then you buy some NASPAS. And last year, if you didn't have enough gold or platinum, you closed that underweight probably at the wrong time. So you're always chasing the index. And the one thing we're doing is we're not chasing the index. We buy on a 3-4 year view, and we have no regard for the index at all. And the black line tells you that it works in the long term. So the second thing I'd say about how we do it is, like, it looks pretty simple there because the black line is on all time periods well ahead of the index and other funds. But within that time period of 25 years, there were a lot of very tough times. And you can't really see it. You can see it a little bit where that black line sort of in 2015 came down quite a lot and got close to the index. And that was our worst period of underperformance. So it looks plain sailing, but on a 1 and 6 month, 3 months, 6 months, 1 year view, there were often periods of substantial underperformance. And if we actually look at the outperformance we've achieved over that period, 80% of that outperformance has come in like 4 periods. So that's 25 years of history. And I'm saying there have been 4 big positions that we've taken. So one every 5 or 6 years. And when those work, we outperform on multi-year period. And sometimes it takes a long time to work. So if I go back on the 25 years, you can see 2000 to 2009 was a great period for the fund. That was when in 2000 we put all the money in South African shares, nothing overseas. As some of you remember, 2000 the rand was 12 to the dollar, and South African shares traded on 7 times earnings. We had nothing overseas, nothing in tech, much the same as today, and everything in South African shares. And that worked well for 10 years. And then in 2008, we did well. We didn't have commodities at the top of that bubble. And then we had the very tough period for us was 2012 to 2015, when we underperformed for 4 consecutive years because we bought platinum too early. And that cost us a lot of clients and a lot of heartache. And that's the longest period of underperformance we had, which was 4 years. But then you see 2015, 2016, platinum came right, and the black line then went up. And then more recently, we've done well buying South African shares in 2.5 years ago, just ahead of the election, and selling out 6 months later. And recently, we've just bought back into South African shares. So if I have to say, the outperformance has really come from 4 of those events. And the shortest period we've had to wait is maybe 3 months, which was actually after the election in May 24. And the longest period of underperformance was when we bought platinum in 2014.
Sure. So, John, what is the recipe for the success? I mean, do you have a formula?
So we've got a couple of slides here on the philosophy, and this is probably the key slide. And so the first thing is what I said to you is we take a longer term view. We're not worried about the index. We do the work, we take the position, and we wait. More specifically, this is what we do. The first thing is everything we buy is, first of all, selected on a bottom-up basis. So I don't sit down and think, I think the oil price is going up, I think the gold price is going down. I start off by saying, I want shares that are, doesn't matter how you look at it, are incredibly cheap, be it on a PE, EV, EBITDA, EV to sales, price to book, price to placement. Everything in the fund is always on a low valuation. And the second thing is the shares must have done really poorly. So there are no bulls left in the shares. Most of the shares we buy have been underperforming for a number of years. So it's no good. We're not buying things that have gone up many times and then pull back 10 or 20%. We buy things that have been falling for usually 5 to 7 years. And they reach multi-year lows, and they are on very low valuations. And whatever's in the fund, you will never see a share on a high valuation. And that's the first rule. So everything's done bottom up, and to be honest, that's kind of an easy thing to do. If you could almost get a AI to do that, to pick the cheapest shares. The hard work is really on step 2, which is to eliminate, to do the work on the share and to eliminate the shares that are cheap for a reason. And there are two things that cause us to throw shares out. So we pick all these. In South Africa, there's only really 70 shares to buy, and we pick the 10 cheapest, and then we go through those 10 cheapest and we do a lot of work on them, and we throw out the shares, or we don't buy the shares that have too much debt. So that's a very important thing, because value investing is hard enough anyway, and if you've got a stock with too much debt, the clock is ticking all the time for something to go right, because it could go under. So we avoided African Bank and Lonman back in the day because they had too much debt, and maybe more. Today, the stock we don't have in the portfolio is SAPI, which ticks box 1 on a bottom-up basis. It's done incredibly well, incredibly badly. It's fallen from 100 to 10. It's incredibly cheap, but it's got $2 billion of debt. And even though we're tempted to buy it, we're not buying it because we think there's a good chance of a rights issue, and we wait. So we do a lot of work on the balance sheet, and so let's say we've got 70 shares in South Africa to buy, and we get down to the top 10, probably 5 out of 100 that we pick, we throw them out because there's too much debt. And then the last thing we look at is there a step change or some paradigm shift that's happened that means the business is obsolete? And so the example is, years ago, Offshore, Kodak came up as screening incredibly cheap, and it was, but even I could work out that Kodak, the business was really done because of cell phones and pictures. The printing of photographs was done. So we checked that the business isn't obsolete. So probably 5% of the shares are not bought because of the balance sheet, and another 1 or 2% aren't bought because it looks like the whole business is obsolete. And then the last thing is, we're aware of how the value gets unlocked. And usually the value is unlocked through some top-down catalyst, which means a movement in the commodity price, which means a movement in interest rates, which means a change in consumer spending, something that is hard to forecast. So step 3, we don't really worry about, but we're aware of what we're looking for. And very importantly, this is impossible to forecast. So we don't wait for the catalyst to come. Usually it's a macroeconomic factor, but I don't wait for the catalyst to come. So using 2015, when we bought all the PGM stocks, they were incredibly cheap on a bottom-up basis. They didn't have too much debt. We didn't think they were obsolete, and we bought them, while the PGM prices were still falling. We didn't wait for the PGM prices to turn, which means we bought them way too early. And in this case, we bought them 3 or 4 years too early, but we kept averaging down. And the day that the PGM prices turned, which, by the way, was impossible to forecast, if you bought then, you'd be too late, because on month 1, the shares doubled once the PGM price. So you have to have the position in place for when the top-down macro catalyst comes through.
So the PGMs, that was like Impala went from like 20 Rand to 200 Rand, eh?
Yeah. So, the share was 240, and then it fell to like 80, and we started buying at 80, and we finished buying at 20. So our average in was, say, 40, and we bought,
Yeah.
I remember buying it every day for 100 days in a row. So we had 10% of the fund in when the share was 20 Rand.
Yeah.
And month 1 of the turnaround, it went from 20 to 40 in 1 month. So you've got to, and then eventually we sold it all out for 120. So in the end, we made 3 times our money. The share then went back to 240. And a lot of people then say, you should have hung on more. But the real money was from 40 to 120. And 120 to 240 is money, but that's only doubling your money. Trebling your money was early on. And obviously, I'd like to have bought it all at 20, but, it doesn't work like that.
Yeah.
But, all right, so we contrarian, you bottom up, and what Buffett said all those years ago, you pay a very high price for a cherry consensus, which is, if you look at tech in the US today, that's the case. If you look at AI, that's a cherry consensus. We're not interested in that. We want to buy, there's another another quote, which I don't think I've got here, which is, we buy humiliation, the stock must be humiliated, and we sell hubris, which is a cheery consensus. So these are all things that drive stocks, and all the dark blue ones, there's no doubt that they drive the stocks in the long term. But the only thing that really matters to me is valuation, because to be honest, that's the only thing I really know. When I go home every day, the quality of the management, what the macroeconomic outlook is, the earnings surprises change every day, and I don't actually know them. I'm guessing them. The only thing I actually know is the valuation. So the valuation for us is massively upweighted. We do consider all those other dark blue bars, but they are small in our decision making. Valuation is the majority.
Okay.
And I think this is, I made this slide like 25 years ago, and it's looking a little bit old, but it's the most important thing. If you look at that little matrix at the bottom, is the future is totally uncertain. And, Nick and I were analysts together for 10 years, and we know that when you're forecasting earnings, you're generally wrong. What you're forecasting, what the company's going to earn in 3 years' time, it's really just a fantasy. And even great analysts like us did a pretty poor job of that. But so really, the world is divided into high valuation and low valuation stocks. I put PE here, but it should really read high valuation, low value. There are only two types of stocks in the world: high valuation, low valuation. And the future is either something good is coming out and something bad. And my experience is that I'm not very good at foretelling the future. And so really, if I'm good at it, it's 51-49, me guessing what's going to happen. So it's kind of 50-50. And what you want to avoid is that top left-hand quadrant. When you're in a high valuation stock, the top right-hand, I should say, you're in a high valuation stock and something bad comes out. That's when you lose all your money. And what you want to be in is in something on a low valuation, bottom left, and something good comes out. And often when we're in these low valuation stocks, something bad comes out. And, if you bought the stock on a low enough valuation, really the answer is the share doesn't even go down. And that's a great sign that we're in the right stock. We buy it. It's been falling for 7 years. More bad news comes out and the share doesn't fall. That is a sign that all the bad news is in the price.
Okay. So this is a real buy low, sell high, eh?
And longer that I'm in this business, the more, even if it's a good story, once we've made our money, we sell. Yeah. And because we might sell too early, but you never go broke on a profit. And if you've made 1, 2, 3 times your money, there are not many. There are exceptions. Sometimes, like Naspers, you make 3 times your money, it still keeps going. But we're very happy. Once we've made 3 times our money, 9 times out of 10 we sell everything. And the proof is in the pudding. All right, so that's kind of how we do it. But maybe when we talk through how the fund's positioned, you'll get a much clearer view of our thinking. So to start with, I thought I'd just take 5 minutes. These are kind of big picture thoughts about the market, but it'll give you an idea of how we're thinking and how we position. So the first thing is we do have 25% of the fund offshore in the Global Value Fund, which I also run. And in that fund, we basically have nothing in large cap US and nothing in tech. And people would say, you need to be in the US because the US is the world's strongest economy. And they've even got a nice term for it, which is US exceptionalism. Europe's a dead duck and America's the place to be, and tech is obviously the place to be. And here I would just look at the top left-hand slide, which shows 2020 to 2023, so it's after COVID, which countries were running a big fiscal deficit. In other words, they were borrowing a lot of money. The government was borrowing a lot of money, and it's regressing the amounts of the deficit compared to the growth. So the deficit is on the bottom axis. So you can see the US is far left because it's running a 9% over those 3 years. It ran a 9% deficit. So that means that government expenditure was 9% higher than everything they collected. So they're adding to the debt every year. And then the blue line regresses the amount of the deficit about compared to GDP growth. And there's basically 100% correlation on that line. The bigger the deficit, the further you go left on the bottom axis, the bigger the GDP growth. So the US has achieved most of the growth the US has achieved in the last 5-7 years is because it's run the biggest deficit. And it's very easy. If I want to look good, I can run a big deficit too. I go to the bank and borrow 5 million rand, buy a Lamborghini and drive around. People say you're doing really well. The US is that. And the countries that people consider as dead ducks, Canada and Germany, they haven't grown at all in that time period. But guess what? They actually ran a surplus. So they're not borrowing money, the US is. And that's a very important thing. And the US growth is all coming from one or two things. So it's a very clever graph which shows you the size of the bar is the size of overall GDP growth in the US. So you can see it's a great picture the last 4 years. It's grown between 1.5% and 3%, 3.5%, and it's grown better than the rest of the world. And then it divides up the growth between AI investment, in other words, the capex that is going by the big seven to build data centers is the blue. Upper income, the top 10% of US people, what they're spending, and that's obviously consumption is really important because it's 75% of the US economy. And then everything else is the green. And it shows you the growth in the last 2 years in the US has all come from AI investment, and then it's come from the spending of the top 10%. And the rest of the US economy, the green bars, the contribution is just whittling away. So, and the green and the blue are really the same trade. As the top Magnificent Seven spend the money on AI, the shares have gone up. The top 10% of America own all the stocks. They're making gazillions of dollars and they're spending it. So what I'm saying is this US exceptionalism is really it's actually based on the AI spend and the success of the AI spend. So it's not just the AI, the capex is there, but will it deliver the returns? And if it delivers the returns, it will deliver, well, I don't think it will even deliver further growth in the tech stocks because they've already priced it in. But if the AI investment fails or delivers a lower than expected return, the shares will do badly. And so the green, at least the red and the blue bars will both fall together. So you need to be very careful about that. And obviously we have no tech stocks. And generally our exposure to the US market is in small caps that have been ignored by this move.
But John, from this slide, it kind of feels like the US is taking a really big bet on the AI spend.
Yes. And so, you could say, I said, I actually don't know if it'll be successful or not. But I can tell you the share prices, if you look at SpaceX and you look at NVIDIA, the share prices have discounted that the spending will be successful. So it's more to go back to that first slide. I actually don't know. I mean, I think it's unlikely to deliver the kind of returns people hope for because generally I don't want to be investing where everyone else is investing because the returns get pushed down by that a lot of investment. But it doesn't really matter what I think. The shares have discounted that the AI spending will deliver a fantastic return. And I think at best the answer is 50-50. I personally don't think it will, but it doesn't really matter what I think. The shares have discounted it. So I would never consider buying any of those stocks.
Okay.
And obviously, they're the opposite of the shares you want. They're 45 degrees up for the last 3 years. So then just a couple more slides. This shows you how much money is going into US stocks. So this is the share of US equities in the allocation of global equities. So going back a few years, that was 80-90%. 80-90% of all the money that went into equities 3 years ago was going into US stocks. And that number's been falling over time as people are saying, they're starting to think what I'm saying, which is, maybe the US has run too far. So last year, only 25% of the money went to US. So, and the US massively underperformed the rest of the world last year. And actually, the US market, while it's still going up, is actually underperforming the rest of the world. And the point of this slide is you don't need the money actually to leave the US. You just need less money to come in. And that's a big thing. You don't need, for shares to start falling, you don't need people to sell. We just need less people to buy. And that's really what's happening, is the money is not coming to the US at the same rate as it was 3 years ago, which makes sense because there's only been one market up to 18 months ago, which was the US market. So that's that. Then we spoke about the debt. This is the government budget balance. This is the fiscal deficit, which was 9% on that first slide. So you can take out all the, there you see usually most of the spending is in the wartime. But in the last 30 years, if you can take out the up and downs from COVID, it's just a steady line getting worse. They used to run a balanced budget in the 70s, and that has just steadily moved from a balanced budget to, between 5 to 10% deficit every year. And the one thing I know, there's only one thing I know, is the US debt will keep climbing. That's the most important thing. And this is the amount of debt. We're sitting at $40 trillion, exponentially up. And that's the forecast for the next 9 years to get to 60 trillion. And this is done by a bipartisan organization called DBO, which is a neutral organization. It's not the US government. It's like a think tank. And by the way, that's a projection. And in their projection is actually pretty optimistic because they don't even forecast a recession or anything to hurt. And that's where the debt's going. And I'll touch on this later when we get to gold. That is the case for gold. The US debt, and this is another thing I know, doesn't matter what happens, that line is going up. It's just a question of, is it going up in a straight line or is it going up at a 45-degree angle? This gives you an idea of the dollar. So the dollar has been really strong. So when the line's rising, the dollar is strengthening. And you can see we've had 10 fantastic years, 15 fantastic years for the dollar. And the last sort of 18 months, the dollar's come off its best levels. But it's been a strong dollar, and most importantly, it's been driven by the narrative of exceptionalism in the US and the inflow of money into the US equity market, which now is foreigners hold $1 trillion of US equities, the highest ever by a long way. And this gives you an idea. There's only been one market in the last 15 years. This shows the US relative to the rest of the world. So everything else, the US is now 70% of the world index. Used to be 30, 40%, is now 70. For 10, 15 years, it's just straight line up for the US, the rest of the world. And then, as I alluded to, the last 18 months, it's come off its best levels. While it's still risen, it's risen slower than emerging markets and some other markets. Mm-hmm. Emerging markets, we think, is the place to be. So in the offshore fund, we got quite a bit of money in emerging markets, and South Africa is included in that. I'll touch on our positioning in South Africa, which is part of the emerging market index. It feels very much like 2001 to me. I mean, we alluded to the fact that 2001 was the top of the dot-com bubble. We think we're at the top of the tech bubble today. Emerging markets are at the same level as they were then, and then they went through this. I mean, that is a fantastic period from 2000 to, say, that 10 years means that the emerging markets beat the US by 4 times over that period. And we're seeing that turn again. Today, it feels very much like 2000 to me in terms of that as well. The PE is basically as high as it was in the dot-com bubble. It's as high as it was in the 1929 crash. The price to book has never been higher. It's actually exceeded the dot-com bubble and much higher than the Nifty 50s or the Nifty 60s. So the valuation on price to book has never been higher. And then this is an interesting graph. Offshore, in the offshore fund, I'll show you at the end what we invested in. Maybe 40% of the fund is in staples. So these graphs come out from Merrill Lynch and only come out once a year. And when I saw this graph a few months ago, I was like, oh, now I know why 40% of the fund is in staples, because staples looks like emerging markets. Right? And exactly March 2000, everyone was buying tech, no one was buying beer or food shares or alcohol shares or whatever. Everyone is buying tech. Today is exactly the same. But the shares have found their way into the portfolio, not by me seeing this graph, but by me saying, oh, this is Heineken is trading at a 10-year low. The spirits companies at 10-year low. The shares bottom up, find their way into the portfolio. And then I see this graph and I understand why they're screening so attractively, because they're now perceived to be boring. And a month or two ago, you could have bought Heineken on like 12 times earnings, which is, for such a business, is just completely wrong. So we got staples overseas. And then these are probably the two key graphs for the story of South Africa. So I've touched on internationally. Domestically, if you put your money in the South African index through the cycle, basically, in other words, sort of normalized, basically a third of the South African market is commodities, a third are multinational stocks, things like InBev and Richemont and Naspers, and a third are domestic shares, which are banks and industrials. And at the moment, in the South African part of the value fund, the 75% that is domestically, basically 85% of the South African part of the portfolio is in domestic shares only. So we kind of at nearly triple weight domestics, and outside of domestics, the only non-domestic we really hold is some investments in gold again.
Okay. So like SA Inc., as they call them today, huh?
SA Inc. is really the whole portfolio domestic.
Okay.
And before I touch on what shares we have, this is, let's call it the big picture for SA Inc. So what we got on the screen here is what expected inflation is in different countries over the last 10 years. And, you can work out what the market expects inflation to be off something called the TIPS market, which is inflation-adjusted bonds. And reading off that, you can see what the bond market, which is a massive liquid market, is expecting inflation to be over 3 and 5 year periods. So it's a good proxy for what inflation is and what inflation is expected to be in a country. And you go back 10 years ago, we've got a lot of countries here, but I'd like to focus on the US, which is the blue line, and South Africa, which is the green line. So 10 years ago, inflation was 5 or 6, and in South Africa, and inflation expectations were 6%. The US was a 1% inflation environment, and people expected 1% inflation. So 10 years ago, we were a 6% inflation country, and the US was a 1% inflation. And in those days, I would have said that's when you can call one currency hard, being the dollar, and one soft. When there's a 5% inflation gap, you can expect the rand to depreciate by 5% per annum. Roll forward 10 years, thanks to the Reserve Bank, the Treasury, that part of South Africa is run like Switzerland. Now, the rest of South Africa isn't run so well, but the Treasury and the Reserve Bank do an excellent job, and they have fulfilled their mandate and reduced inflation expectations from 6 to 3.5. The US has gone from 1 to 2.5%. So the inflation gap now is like 1.2% between South Africa and the US, whereas it used to be 6. So that has been through responsible monetary policy in South Africa and irresponsible monetary policy in the US. I would just say one thing on the US. It's not that they don't know what they're doing, because they know exactly what they're doing, is when you go back to all that debt that I showed you, they have too much debt, and their only way out is to inflate away the debt. So they have a 2% inflation target, but inflation has now been above 2% for 68 months in the US. So it makes a joke of the target, and I'm saying they're not incompetent. They know what they're doing. They say we still stick to 2% inflation, but it's not what they say, it's what they do. They don't hike rates when they should be, because they're trying to inflate away the debt, whereas the South African Reserve Bank, they'll hike rates on an external shock, which is oil. So they kind of do the right thing, and the US is doing the wrong thing, but they're doing the right thing for them, which is to inflate away the debt. So inflation expectations have narrowed massively, and therefore the bond market yields have narrowed massively. So if you go back 10 years ago, South African bond yields yielded 5 or 6% more than the US. Today, the South African bonds are 8.5%, and the US is 4.5%. It's 4. So the bond yield, the cost of capital has narrowed as well with inflation. So the South African bond market's been fantastic bond market. The currency's been fine. And if I said this is the graph, and you said, what about the South African equity market? Anyone who spent a long time in financial markets would say, inflation's under control. The cost of capital in South Africa is falling. The cost of capital is rising in the US. If I looked at this graph and no one looked at an equity market, you said, do you think South African market? So clearly the South African equity market must have outperformed the US equity market. And whatever the discount was 10 years ago, the discount should be less. Mm-hmm. And the answer is, when you look, how is the South African equity market done? It bears no resemblance to what you'd expect. So there's a lot of lines here, but let's focus on the second line from the top, the S&P 500, which is the red line. This is the PE. And if you go back 10 years ago, which is halfway back on this graph, the PE was kind of 15 to 20. Let's call it 16, 17 times. And South Africa is the green line. South African PE was like at a small, it was actually fairly close. It was maybe 14 times. So 10 years ago, the South African market was a 14 PE, the US market was a 15 PE. You would expect that, to have narrowed further. But today, the South African market trades on 10 times earnings, and the US market trades on nearly 25 times earnings. So it makes absolutely no sense because, as important as, as an analyst, we know, Nick and I know, when you're doing a discounted cash flow, the cost of capital is the biggest input you can put into the discounted cash flow. And our cost of capital has fallen and theirs has risen. And yet their PE has risen 50% and ours has fallen 30%. So South African equities, simply put, this is emerging markets, Japan, Europe, we're the lowest PE in the world. And we don't have Brazil here, but we're on a Brazilian type PE. But in Brazil, bond yields are 15%. In South Africa, bond yields are 8.5%. So adjusted for the cost of money, South African equities are the cheapest shares in the world. And that's not my opinion. Yeah. That's a fact.
You can John, argue, I must just jump in. I mean, what do you think now? What is the catalyst going to be to narrow this gap?
So I'll come back to that, but let's talk about why is that? So why have South African shares done so badly? I think it's 75% because there's been no or limited GDP growth. GDP growth is stuck at 1%. So the bond guys go, you run a tight ship and inflation's under control. But the equity guys go, I'm not interested because there's no growth. So I've got a bit of sympathy for you, but remember that the price of an equity depends on two things. It's how much growth you achieve and what the discount rate is. So the bottom line is when you're buying SA Inc. shares on 5 times, 6 times earnings, which a lot of the mid-caps are on, you don't even need any growth because they're trading on 20% free cash flow yields. So you get your money back in 5 years. So you don't need it to grow. But probably the thing the catalyst you asked for, I think the catalyst is when the growth, it just needs to go from 1 to 2% and people will be interested. And politics is the other thing, which I think is a smaller part of it, which I think has got less. But certainly when I put the slide together 6 or 9 months ago, people were very worried about South Africa fighting with the US. And, that's gone away a bit now because I think people have realized it's more the US is fighting with South Africa than the other way around. So, so it's back to the old story. I don't know when that 2% growth will arrive, but the shares say it's never going to arrive. And if it does arrive and you're in these 5 PE shares on 10% dividend yields, you should make a lot of money. So what have we got? We've got, we got the SA Inc. weighting. This is what 64% is. 64 of the 75 is in SA Inc. And we've got retailers, but we've got very specific retailers. So we've got like the cheapest of the cheap, which is Truworths on 6 times earnings. Pick and Pay, which is basically a negative valuation when you take out Boxer, Tiles on 6 times earnings, and Cash Build on 8 times earnings, all of 5-6% yields. 20% in that. There are a lot of other retailers we've avoided because they've got other problems, but those are our picks. And then lots of hospital companies, life, healthcare, Netcare are nearly 20% of the fund. And simply put, those two hospital companies are the cheapest hospital shares in the world. So the average hospital share trades on 15 times EBITDA or 20 to 25 times earnings because hospitals are good business. In South Africa, those two hospitals trade on 5 times EBITDA, 10 times earnings. So kind of 60% discount to the average hospital in the world. So give you 5 or 6% dividend yield. They've got limited debt and they do just fine. So, and those are starting to do pretty well for us. And then lots of mid caps as well. I'll show you some of the mid caps. I'll come back to that slide. Mid caps, a lot of mid caps, ACI, Raubeck, Sun International, Italtal, Cashbuild. I'll just point to the average there. The average P of all these mid caps, 8 times. Dividend yield, 6%. EV/EBITDA, which is a crude proxy for cash flow, 4 times. So these stocks have done nothing for 10 years, 15 years. You buy them you get your cash back in 4 or 5 years. So they basically saying South Africa is Zimbabwe. There's no future.
And the downside is minimal.
The downside is minimal, and as I say, probably the 2% is what we need. Then the last slide on SA Inc., I just went back and I said in 2001 we put similar amount of the fund into SA Inc. It worked out really well for us. So I went back. There were only 3 stocks that we own in the fund that I could find the data for from 25 years ago, and which were similar companies to what they were 25 years ago. And luckily, they are different. Roynet, which is in fixed investment, Truworths Consumer, and hospital company Nick. Coincidentally, the average PE today is the average PE in 2001. But by the way, we did very well buying these shares on 10 times earnings. But there's that important second point is the bond yield in 2001 was 13%. In South Africa, bond yield's 8.5% today. We did well buying them on 10 times earnings on a 13% bond yield. Today, we're buying them on the 10 PE with an 8.5% bond yield. We should do even better. But even if we just do as well as 2001, we'd be very happy. And then the last one, this is the last slide on SA. I just looked in the fund, 28% of that 75, 28% of the SA portfolio is just in these 9 shares. And these 9 stocks have dividend yields between 6 and 14%, average dividend yield of like 9%. The bond yield is 8.5%. So the bond yields in a lot of these companies, the dividend yield is higher than the bond yield. And then people say, but they're going to cut the dividend or they've got a lot of debt or something. So I looked at the second column shows you the last interim or full set of result. The last dividend they declared, what was it? Most of the dividends were up 10, 15, 20%. So it's not like these companies are doing badly. This is in a 1% growth economy. Most of them are growing their dividends at 20%. And there you see the last column, only 2 of them have a lot of debt, which is Zeda and Sun International. Some of them, like Caxton and Cashbuild, actually have their whole market cap in cash. So they're not leveraged. They're growing their dividend, and you can get a 6% yield.
Yeah. I'll just chip in. So obviously, Zeda, car rental company, they leverage their asset base. Yeah.
Correct. So you would expect the debt to be high there, and it is high because that's how they get their returns. So Zeda is, I've got some sympathy that Zeda should be on a highish dividend yield because it is a higher risk business, but 14% is, but then you look at something like Cashbuild, which is on a 6% dividend yield. They've got nearly the whole market cap in cash, and it's a pretty stable business selling building materials with, so definitely Zeda should be on a higher dividend yield, but not 14. And the beautiful thing about this is if these let's say the average dividend here is 8 or 9%, if you buy these shares, you're gonna get the same return as the bond market. The dividends are gonna grow, and then people go, but how am I going to make a capital return? Well, the answer is, if the dividend goes from 9 to 6, which it should when the bond yield's 8.5, you make 30-40% capital return just in that re-rating.
Yeah.
So these are just completely incorrectly valued, in my opinion. But it's caused by foreigners not being interested. They've sold 80 billion rands worth of shares in South Africa this year.
Hey, John, I mean, this has all been super interesting, but I'm just saying, time-wise, we've got about 13 minutes left or so, and we've also got just a few questions.
All right, so I'm going to wrap up by talking about last few minutes. I'm going to talk first about gold for a few minutes, and then just show you what we've got offshore. So gold is interesting because we've held a lot of gold in the last 5 years, and it's helped our performance a lot. We started off with Anglo Gold, and then we had Pan-African, then we had a lot. We sold by the beginning of this year, we got down to 0 gold, and we had gold shares offshore. So gold got, simply put, it just went up too quickly. The gold price went in a straight line to 5,500. The gold shares went up like 6 times. And so by January, February this year, we just thought it was overheated, so we sold everything. And now we've just started buying back in, and we've bought 6-7% of the local fund in Harmony, which we think is the best South African gold share, and we put 10% of the offshore into Harmony and Barrick and Newmont. So we used to have, at the peak, we had 20% in gold, and now we've got about 8 or 9% in gold. So we've, in this pullback, because gold shares the last 6 months have fallen 40%, which is another reason the SA market's down this year. But the long-term story we think is still there for gold. So just going back to those first few slides, the US deficit, and not just the US deficit, the deficit in the whole Western world, every country in Europe, Japan, the UK, the debt and the deficits look similar to the US example. So the debt level has now got too high. The West can no longer save their way out of the thing through austerity. So there are only 2 options left, which is default on the debt, which all I'd say is unlikely, because if the US defaults on its debt, I don't want to think about what could happen to the world. So it only leaves the third thing. There's only one more option, which is to inflate away the debt. And how you do that is you keep short-term interest rates below inflation over extended time period. And what that does is, if you think the man in the street has got $10,000 in the bank, if you keep running inflation well above the 2% target and you get interest rates below, it means you effectively confiscate the wealth of the savers, who's the man in the street, and all institutions that put money in the bank. Anyone who's holding cash, they lose money in real terms, and the money they lose, the value is transferred to the people who are holding the debt, which is the US government. And by stealth, over like a 15-year period of keeping negative real rates, you confiscate the wealth of the savers and you inflate away the debt that you hold, and you stay in power. You don't default, you don't raise taxes, so you as a politician quietly steal the money. And that is what is happening. It's been happening for the last 5 years in the US. So what does it mean? It means for private investors and pension funds, you used to, in the old days, remember, it used to be the 40-40-20 portfolio, 20 in cash, 40 in bonds, 40 in equities. You no longer can put 40 in government bonds because, frankly, there's no yield or not enough yield compared to inflation, and they can't pay you back. And you can't have the money in the bank because you get a negative real return after inflation. So gold, for the private investors and pension funds, replaces bonds and cash as a safe haven asset. And for central banks who used to park all their money in US dollars, they're going, our reserves used to be in US dollars, but we don't even get a positive real return. And we've also, the US government has shown if they don't like us, they confiscate our reserves. They showed that with the Russians 4 years ago. Gold replaces the US dollar as a place for central banks to park their money. And gold has gone from gold used to be 70% of all the reserves in the world, reserve banks. It went as low as 10, 15 years ago. It's now up to 30, and it could go back to 70. So the central banks are buying gold, and the man in the street is buying gold.
And, Yeah, I mean, that's super interesting. Obviously, for gold, always mean negative real rates has been the real kind of catalyst trigger for gold to shoot up, which
Yeah.
happened in the past there. Can I maybe just ask you just about the gold? I know you said Harmony. I mean, are the gold shares discounting? What value are they discounting in terms of the gold price at the moment?
So if at the current gold price, so the gold
Yeah.
price was 55 at the top, it's 42, 41 now. Harmony will trade on about 3.5 times EBITDA. So let's call it 4 times cash flow.
Mm.
And their life of mine is like 15 years. So it doesn't even discount 4,100. I mean, it's subjective, but they're probably discounting $3,000 as gold.
Okay. Yeah,
So
they've
I
come
think
down so much, eh?
so I think it's just a pause, and it's time to get back in because certainly the tourists in the gold market, people who didn't really know they've all been washed out in this correction. And maybe let me just go 1 minute on this slide. This shows you the bottom pane shows you when gold is beating T-bills, which is really cash, which, as you say, it's been recent. And the green bars are when the red goes positive, and it's when there's positive. The green bars are where they're negative real rate.
Mm-hmm.
So you can see the disastrous time for gold was 1980 to 2002.
Mm-hmm.
But gold bottomed in 2002 at $200 because there were no green bars in that 30-year period.
Mm-hmm.
There was positive real rate as Volcker and Greenspan killed inflation. And since 2002, gold has massively outperformed because there are a lot of green bars. There's been a lot of negative rates because of all the printing of money. And then the most interesting thing is the last little period, there's no green bars for the last 2 or 3 years. So we actually did get positive real rates the last 2 or 3 years, but gold went up anyway because people realized what's happening. And we're heading back towards negative real rates in the US. So that will be the next leg up, I think, for gold. All right, so one last slide, which is what we got offshore, and that is we said 43% is in staples, which is in spirits, beer, and other staples, which is cream, soup, Reckitt Benckiser. Emerging markets are big in these companies. Spirits companies is the biggest bet. Spirits companies were considered about the best stocks up to 5 years ago, but then the last 5 years, there's been falling volumes in spirits, and people now perceive that people don't drink anymore, which is not true. All we've had is a massive destocking after COVID because people drank more in COVID and people stocked up. And so these shares, Remy, Peugeot, Diageo, Campari, are down 75% off their all-time high. They are unbelievably cheap. I mean, Remy is our biggest holding. The value of the company it's valued at the same as the stock value at cost in their cellars. The cognac in their cellars at cost is equal to the whole value of the company. So that's how the market doesn't even have a business going forward. And then we've got shares that are down 80%, depressed brands, Doc Marten, Samsonite. We've got the 10% we put back in gold. And then we've got Adobe, which is the first IT share I've ever bought, which has gone from $700 to $200. As everyone's rushed into AI, they've thrown out the software companies. And Adobe trades on 11 times earnings, which just looks wrong to me. So a lot of, the average stock here, offshore, is down 75% off their all-time high. And offshore, we've kind of kept pace with the index for the last 11 years, which is pretty good because we've had no tech at all. So it's even more severe than the South African. And these shares, we're pretty excited about going forward. So that's what we got. Locally, we've spoken offshore, 75 local, 25 offshore. And yeah, I think we've done well, but we haven't done well because value's done well. We've done well. Value in the last few years has done better, but it's hardly been a value market. And we're back all into SA Inc. And, in the end, the fund is positioned for SA to get its proper rating, and it's positioned for tech to do badly and for some of the hype in the market to do badly. So on a day like today, when tech is under pressure, all those defensive shares actually go up. So it's kind of a safe-ish portfolio from that point of view.
Yeah. Oh, thanks, John. I mean, there's so much good detail there. Thank you very much to absorb all of that. I mean, it's not easy, but thanks. It's many years and years of experience coming through in a short period of time. But the big thing is SA, a catalyst for SA to kick. Obviously, we need positive politics coming through. Inflation, inflation looks like it's going up. Obviously, the war in Iran's not helping. More spending, of course, as well for the debt. Then coming into the negative real rates. So that all fits in for how you're positioned at the moment.
So we're excited. I think we're doing pretty well, but I think, and the last thing I'd say is, whenever I look at the portfolio, it's never like the value of the portfolio is twice what I paid for it. The portfolio is always pretty close to, so we sell our winners and we buy the losers. So we're never sitting on massive unrealized profits. So whenever you buy in, you're buying into a fund that has got, that pretty much at all times, the in price and the current value are the same. It's not like you're buying, if you buy a tech fund now, you're buying the tech shares at 10 times the in price. That's a very important thing. We're always, the winners we trim out and the losers, we add. And that's a very important.
Yeah. Well, good. Obviously, you mean a formula that's worked. Thanks, John. Really appreciate your insights. That's been fascinating. Thank you, everybody. Thanks for joining us. And we'll be sending this out, and you can view it on our webpage. John, appreciate your time. Hey? That was excellent. Superb. Cheers. Bye, everyone. Bye.